You see, for literally thousands of years, gold has had this unique status. It's not just some shiny metal. For a huge chunk of human history, it was money. Think about it. Governments can fire up the printing presses and create more currency whenever they want. But gold? You can't just print more gold. That scarcity, that universal acceptance, that's what has made it such an enduring way to store wealth. And this quote from the legendary banker J.P. Morgan, man, it just hits the nail on the head. What he's really saying is that gold is a real, tangible thing with value baked right into it. Everything else, every dollar bill, every stock, every bond, it's basically a promise. It's an IOU that completely depends on someone else's ability to make good on their end of the deal.
So, that brings up a big question. Why do so many people, and even massive central banks, still hold on to so much gold? The simplest answer is protection. When things get chaotic in the markets, or when inflation starts eating away at the value of your cash, gold is often seen as a safe harbor. It's a way to keep your wealth safe when other things are sinking. It's really just financial insurance.
Okay, so if you're thinking about getting into gold, you're immediately faced with a really fundamental choice. And this isn't just about picking some product off a shelf, it's about figuring out why you're even buying gold in the first place. Are you trying to save, or are you trying to speculate?
And this slide, this lays it out perfectly. On one side, you've got physical gold. That's about owning the actual, tangible metal. Think of it as long-term financial insurance. Then, on the other side, you've got paper gold, and that's a completely different ballgame. It's all about speculating on the price of gold using financial tools without ever actually touching the real thing.
Which leads us to probably the single most important question you have to ask yourself. What is your actual goal here? Are you trying to make a quick buck on a short-term trade? Are you looking for a medium-term investment? Or are you really trying to save and preserve your wealth for years to come? Seriously, how you answer that question is going to tell you exactly which path is the right one for you. All right, let's start by walking down the first path, the one where you own the real thing. The whole mindset here is totally different. You don't buy physical gold thinking you're going to trade it next week or next month. You treat it more like an insurance policy, or maybe like a family heirloom. It's a core asset, something you buy to secure your wealth for years, maybe even for the next generation. So, the most straightforward way to own gold is through bullion. You know, these coins and bars made by trusted mints. What's great about them is that their value is tied almost one-to-one with their weight and the current market price of gold, which you'll hear called the spot price. It's about as pure an investment in the metal itself as you can get. Now, besides keeping it under your mattress, which I don't recommend, there are other ways to own actual physical gold. Things like gold certificates or allocated accounts mean that you own specific segregated bars or coins, but they're stored for you in a super secure professional vault. So you get that direct ownership, but with top-tier security. Okay, let's totally switch gears now and explore that second path. This one is not about owning the metal itself. Nope. This is about investing in the idea of gold, really by just speculating on where its price is going to go.
And yeah, this image really says it all. We have definitely left the world of insurance and walked straight into a casino. These financial tools, they're built for traders who are trying to profit from short-term price swings. The potential rewards, sure, they can be higher, but the risks are, too, way higher.
Probably the most common way people play in this space is with an ETF, or an exchange-traded fund. They're super easy to buy and sell on a stock exchange, which is why they're so popular. But here's the crucial part. You are not buying gold. You are buying a share in a trust that claims to own gold. That means you're now exposed to the risks of that trust and the whole chain of companies that are supposed to be managing and storing the metal. Then you have something called gold futures. Honestly, these are contracts for professional traders, not for the faint of heart. They use something called leverage, which basically means you can control a huge amount of gold with just a little bit of your own money. And while that can magnify your gains, it can also magnify your losses, sometimes to the point where you could lose way more than you ever put in. So the big takeaway with paper gold is this. Your risk is not just about the price of gold going up or down. For example, let's say you own stock in a gold mining company. Now you're exposed to things like bad management, or rising fuel costs, or even political problems in the country where their mine is. There are just so many more things that can go wrong. So, we've looked at the two big paths, gold as insurance versus gold as speculation. The question is, how do you fit these two very different ideas together into a smart, balanced strategy?
Well, the investment pyramid is a fantastic way to think about this. Your foundation, right, the widest, most stable part at the bottom, that should be your safest stuff. That is where physical gold bullion belongs, acting as your financial insurance. As you move up the pyramid, the layers get smaller and riskier. And those really wild speculations, like futures, they should only be a tiny little piece at the very, very top.
This table does a great job of showing the trade-offs. Just look at that last column, counterparty risk. That's just a fancy way of saying what's the risk that someone else in this chain doesn't deliver on their promise. With physical bullion that you own directly, that risk is super low. But with ETFs and stocks, you're relying on a bunch of other companies to do their jobs right, which just adds more layers of risk. In the end, you're often just trading real security for a little bit of convenience.
And so it all comes back to you. It comes back to your goals. Now that you've seen the two paths, gold as a rock-solid insurance policy versus gold as a speculative bet, the real question is, what kind of portfolio are you trying to build? Are you building one with a solid, tangible foundation, or one that's more focused on high-risk, high-reward trading? Only you can decide what kind of foundation your wealth really needs.
Thank you for watching. If you found this video helpful, take a moment to like it. It really helps the channel grow. If you enjoy learning and understanding how things actually work, consider subscribing. On this channel, we explore a wide range of topics,